In this video, we're going to be performing a deep dive on Cincinnati Financial's dividend safety. To begin, let's talk about Cincinnati Financial's business model. Cincinnati Financial is an insurance company founded in 1950. It offers business, home, and auto insurance, as well as financial products including life insurance, annuities, and property and casualty insurance. Instead of focusing solely on high-margin products like some other insurance companies, Cincinnati Financial is willing to write lower-margin policies. Cincinnati Financial trades on the New York Stock Exchange with a market capitalization of approximately $12.6 billion. Cincinnati Financial is a well-known dividend stock because of its compelling track record of dividend growth. With 58 years of consecutive dividend increases, Cincinnati Financial is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, Cincinnati Financial's dividend history satisfies the requirement to be a dividend aristocrat more than twice over. With more than 5 decades of dividend increases, Cincinnati Financial is not just a dividend aristocrat but also a dividend king, an even more exclusive group of stocks with 50-plus years of dividend increases. Looking ahead, investors cannot rely on Cincinnati Financial's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Cincinnati Financial's dividend safety in the context of the company's current earnings. When Cincinnati Financial reported third quarter financial results on October 25th, the company reported that it generated adjusted earnings per share of 84 cents in the 3-month reporting period. For context, the company currently pays a quarterly dividend of 53 cents, which implies a payout ratio of 63% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Cincinnati Financial generated $2.37 of adjusted earnings per share through the first 9 months of 2018 and distributed $1.59 of common share dividends during the same time period for a year-to-date payout ratio of 67%. Using earnings, Cincinnati Financial's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Cincinnati Financial's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Cincinnati Financial generated $826 million of free cash flow and distributed $351 million of common share dividends for a free cash flow dividend payout ratio of 42%. Using free cash flow, our conclusion is the same as when we used earnings to measure Cincinnati Financial's dividend safety. The company's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Cincinnati Financial's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Cincinnati Financial's performance during this time period is shown here. Cincinnati Financial's earnings per share performed quite poorly during the last recession, declining by 79% on a peak-to-trough basis. With that said, the company continued its multi-decade streak of dividend increases. While Cincinnati Financial managed to keep its dividend streak alive during the last recession, we recommend that investors monitor its performance closely during any future economic downturns. The last angle that we will use to assess Cincinnati Financial's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Cincinnati Financial generated $40 million of interest expense and had $830 million of debt outstanding for a weighted average interest rate of 6.4%. The following image shows how changes to Cincinnati Financial's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Cincinnati Financial's weighted average interest rate would need to rise to well above the 25% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Cincinnati Financial's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.